Hello, everyone. Thank you for having me here to deliver the keynote talk. I'm going to share a piece of work related to the theme of the conference, financial technology and business analysis. It is a joint work with Kaohsiung Hao from Southwestern University of Finance and Economics, Jenny Guan from Monash University, and Li Xinyu from Shandong University. Let's start with the motivation. Since 1990s, the number of stocks on the major stock exchanges has steadily increased. For example, as of 2022, there are more than 2,500 stocks listed in NYSE and more than 2,000 listed in Shanghai Stock Exchange. To select stocks from a large pool of candidates, there's a daunting such problem because investors, they could not acquire and process of all kinds of information. The financial advice that could guide investors to select stocks and allocate capital could play a critical role in shaping the financial markets. Prior studies show that institutional investors use financial labels, for example, stock index like S&P 500 and FTSE 100, and style index such as growth and value labels to allocate funds, and those flows they are associated with material market outcomes. The individual investor also play a role in the financial market. For example, retail trading could influence stock returns, market volatility, volume, and depth. Yet little is known about the financial advice consumed by the individual investors. The purpose of this paper is to investigate the impact of advice consumed by the individual investor on the financial market, and more importantly, whether this advice translates into systematic patterns. Let me introduce what is label. A label could be a tag on the surface of a product. Labels can be used to categorize goods. Stock labels, for example, the index assignment, could help to simplify the stock selection process, and they perhaps are the most important financial advice. We'll take advantage of investment concept label created by the financial data provider in China, Tonghua. The stock market in China is dominated by the individual investors, and Tonghua is the leading or the most popular financial data provider for Chinese individual investor. And the individual investor, they are not likely to follow the index or style-based portfolio strategy as mutual funds or index funds, while they are keen on speculation and investment concepts. Investment concepts, they are labels that are loosely defined categories of stocks. They typically emerge in response to eye-catching events. For example, the Beijing Winter Olympics, the Metaverse conference is announced by the Facebook, now Meta, and international trade conflicts. They provide a warm bed for speculation. In its capacity as the leading data provider, Tonghua will collect and process the concept information. After consulting the expert from Tonghua, we know that they have the macro industry actuary research team will take care of the information and create and maintain the label. And they also have the product team collecting and gathering the information from various sources, including foreign discussions and news databases, to create and maintain the label. And they will also perform the algorithm on the factors attribution and then categorize stocks. And finally, they allow the investor's proposal, or in other words, investors can propose the labels and also like the links between a typical stock and a typical label. After that, Tonghua will place a salient concept label hyperlink next to the title of each stock in the app and on the website. In the meantime, in the concept label page that outlines the list of the stocks, Tonghua will also highlight the newly added stocks. In the spirit of various et al. 2005, will focus on the label inclusion and deletion event rather than the label creation events to identify the pure labeling effects. What could be the market outcome of Tonghua labeling action? Individual investors, usually they have limited attention or computational capacity to process information. The connective process begins with awareness and then progresses to the comprehension of the information signal. Tonghuashun creates a salient concept label hyperlink and highlights the labeling added stock, newly added stocks. And the high salience based on the psychology literature could reduce the awareness cost of the subject and attract audience interest. Nevertheless, the concept label may not facilitate greater understanding. This is because the label per se does not provide valuation estimate. For example, the analyst forecast consensus in IBEX database. After a stock is newly labeled by Tonghuashun, investors of the newly labeled stock, now they may be attracted by the label and they could have a lower awareness cost of incumbent stocks within the same label. As for the concept investor who are interested in a typical like a broader concept and they are seeking for information on similar categorical stocks, and now they have lower awareness cost of newly added stocks and may pay more attention to them. As a result of social interaction and social forces, now investors tend to focus on stocks with similar characteristics, and attention is directed to the focal stock and a broader concept of stocks. In that sense, there could be the spillover of sentiment and also the information concerning the investment label between two groups of investors, and they may allocate funds correspondingly, and we will expect there will be co-movement of capital. And in that sense, one can comfortably predict a critical market outcome of Tonghuashun's labeling action could be subsequent excessive co-movement of stock returns. However, if the reduction in awareness cost is insufficient to motivate the investor to reallocate their attention, or the co-movement of stock return is driven by the changes of fundamentals, we will expect there will be no consequences of Tonghuashun's labeling action. To test our prediction, we'll construct the sample as follows. We'll download all the concept labels from Tonghuashun's database between 2014 and 2021. We have the title of concept, the details of concept stock, and the inclusion and exclusion date of each concept stock. The granular concept label data become only available in 2014. We have the firm level data, including financials, stock price, trading volume, and accounts from SISMAR, the Siyang RDS, and Tonghuashun's database. We'll perform the following sample screening techniques, and we entered with 272 concept labels covering around 5,000 stocks. Firstly, we'll exclude the labels related to IPOs and consecutive labeling events if these two events are occurring within 30 trading days. We also exclude the events if the stock is labeled or deleted with more than one concept within 30 trading days, or if the gap between the inclusion and exclusion is smaller than 30 trading days. We also exclude the events if in the past 30 days prior to the labeling events, there are material announcements, for example, earnings announcement, MMA, and corporate restructuring. We also exclude the events when the label is just newly created. We will then perform a matching practice to construct our control group. The matching exercise in a sense could help us to eliminate the possibility that company level characteristics and industry features could confound our estimation. To be more precise, we have the PSM. We use a one-to-one match without replacement. As for the control firms, they must belong to the same industry as the treatment firms, but not be included in the same stock concept label as the treatment firms. After the PSM, we have a total 8,510 inclusion events. Now let's have a look at the covariant balance. As you can tell, the differences between the treatment group and the control group are minimum, and they're not statistically significant. Now let's move on to the baseline regression. We use narrow windows around each labeling event, the 30 trading days before and after the labeling event. The staggered labeling days provide a natural cosine experiment for us, and we follow previous literature, we'll decide a two-period DID. The short window increases the confidence that any incentive effect we're going to find is more likely to be associated with the labeling event instead of other confounding events, and we estimate the following equation. And for the outcome variable, we'll construct two variables, Pearson 30 and R-squared 30 following Huang et al. 2019 GFE paper. Pearson 30 represent the Pearson's correlation coefficient between the excessive return of the stock and rows of incumbent stock with the same label in a 30 trading days window. A higher the Pearson correlation coefficient, a higher the larger the degree of co-movement of stock returns. R-squared 30 is derived from the cosine Markey model regression in a 30 trading days window. Trade is a dummy variable which equals 1 if a stock is newly labeled with the concept by the Tonghua Shun, and 0 otherwise. Pulse equals 1 for the observations occurring after the inclusion event, and 0 for the observation occurring before the event. Will include a bunch of controls and bunch of fixed effects, including year, quarter, month, and day fixed effects. And in our robustness test, we also use the high-dimensional fixed effect to control for time-varying heterogeneity across different labels to ensure our results are very robust. Now, let's have a look at the univariate analysis. In the univariate analysis, we are not going to compute the outcome variable in the 30-day trading windows. Instead, at each trading day T, we are going to compute the cross-sectional statistics. For example, we'll perform the cross-sectional regression at a typical day T to obtain a adjusted R-squared, and then we plot the statistic we are interested along the trading day. Here you can see for the treatment group, we can observe a noticeable or remarkable jump following the labeling event. But however, for the control group, the patterns appear to be quite stable. So here, from the univariate analysis, we can have a glimpse on the time dynamics following the labeling event. Now let's move on to the baseline regression. For the baseline regression here, you can see all the treatment effects remain positive and statistically significant. Let's have a look at column 1, the magnitude. Now the outcome variable is Pearson's correlation coefficient in a 30 trading days window. The magnitude is about 0.044. It indicates compared to the control group and after the treatment event, the correlation between the excess return of the newly added stock and the growth returns of incumbent stocks with the same label increase about 30% compared to the simple mean. If you have a look at the column 4, when the outcome variable is just the R-squared, the magnitude is about 0.07. It indicates around a 15% increase compared to the simple mean. Combining the results from columns 1 to 6, we believe our hypothesis is satisfied that the Tonghua Shun's labeling action causes the co-movement of stock returns. Now, we would like to investigate the economic channel. If we go back to the theoretical prediction, we believe the co-movement of investor attention could be a critical channel. To test this channel, we will create the search volume indexes, because search intensity on the internet can be used to measure investor attention. We create SVI for each individual firm and each concept label, and we use the ticker symbols as the search term for the companies to ensure the users is searching for financial information. And we perform the regression in a short window regression. It is a short window regression for 30 trading days before and after the labeling event date, and then we will obtain the adjusted R square as the proxy for co-movement of investor attention. And then we perform, like in a similar manner, we perform the two-peer DID. And here you can see after the labeling event, movement of investor attention increases in a positive way and in a statistically significant way, and that provides strong evidence to our economic channel. Next, we would like to have a further analysis of the channel. Let's have a look at the investor of newly added stocks. For the investor of newly added stocks, if a stock, the newly added stock, is associated with several labels, in that case, investors' attention could be diluted and the reduction in awareness cost could be in a lower degree. And in that case, we would expect the treatment effects could be smaller. And also, if the newly added stocks they are held largely by the institutional investor, for institutional investor, they are less prone to limited attention. And in that case, we will expect the treatment effects could be lower. Let's have a look at the empirical evidence. Here we can see in the DID, the triple differences estimation, if a stock is associated with a larger number of labels, the treatment effects are smaller. And also, if the newly added stock is largely held by institutional investor, the treatment effects appear to be lower as well. Now, in the second part of further analysis of the channel, let's have a look at the concept investor. For the concept investor, if the original concept label contains a lot, like in terms of number of stocks is very large, in that case, concept investor's attention is also diluted, and we will expect a smaller magnitude of the treatment effects. And also, if the labeling action could really direct attentions of concept investor to the newly added stocks, we will expect after the labeling event, there will be more individual trading accounts associated with the newly added stocks. Let's have a look at the result. Here, if you have the triple differences result could tell us if the label contains a large number of stocks, the treatment effects are smaller. And also, after the labeling events, the attention of concept investor are directed to the newly added stock. Here we can see after the labeling event, there are more individual accounts associated with newly added stocks, but not we do not observe similar patterns for the institutional accounts. Our interpretation so far relies on the assumption investors will follow the investment concept label to allocate their funds. And now we would like to investigate this assumption or this prediction. In a similar manner, we calculate the movement of stock turnover between the focal stock and the incumbent stock with the same label. And here we can see the treatment effect or after the labeling event, the co-movement of stock turnover increases in a positive and statistically significant way. So our assumption is valid. After that, in the next step, we would like to rule out the fundamentals-based explanation, because one may concern or one may worry after the labeling event, the fundamentals are changing. So in these cases, those cases could drive our results. And here we'll construct the estimation in a -A to A and -4 to 4 quarter window. And our outcome variable of interest is EPS, earnings per share, and NCF, the net cash flow. And here we can see, following the treatment event, the fundamental remain quite stable. There's like no change, and the magnitude is also very, very small. Next step, we would like to investigate the label deletion event. When Tonghua Shun removes the stocks from the label, we will expect the pattern will move in the opposite direction, will be a negative one, because the co-movement of investor attention, the channel collapse. More importantly, if our results on inclusion is mainly driven by the time variation instead of the labeling effects, we will expect there will be the treatment effect in terms of like label deletion will be insignificant. Here you can see from the empirical evidence, the label deletion treatment events, they are significant in a negative way. So we are confident that the Tonghua Shun labeling action causes the co-movement of stock returns. In the next step, we'll perform a battery of robustness test. For example, we'll use the multiplicative fixed effect to ensure that we separately estimate the impact firm, year, quarter, month, and day on observed linearity for concept label. And we'll also construct an alternative control sample because one may worry certain label level characteristics may be hidden in the error term and bias of our estimation. So we identify the control firms by selecting firms from the incumbent stock with the same label and applying the PSM methodology. And in next step, we also control for the confounding events, including price limit hit, noise trading days, and if there are discussion prior labeling event on the Hudong platforms. Let me conclude and summarize the paper. We are the first to investigate the impact of financial advice in the form of financial labels consumed by individual investors on return co-movement. We will extend the literature on non-fundamentals-based return co-movement, and we answer the call for research on social finance. To be more precise, we will document the effects of interaction of individual investors on aggregate market outcomes. Will contribute to the debate on cognitive processing cost, as we'll show that financial label can significantly influence investor behavior as it reduces the awareness cost of stocks while conveying no valuation details. Finally, we believe our paper could contribute to the studies on role of financial data supplier. Individual investor, as in our study, may follow Tonghua Shun's concept labels in selecting stocks and allocating funds, and investors rely heavily on the financial intermediary. In this paper, the financial data supplier for information signal, as opposed to directly assessing them by themselves. Okay, I think that's the end of this presentation, and thank you for listening.